Welcome to the Level 1 Financial Reporting and Analysis Summary video series. This video is a summary of the reading on Financial Reporting Standards. Reporting Standards. Here the key standard that we need to be aware of is the IFRS, and knowing this picture and a little bit about every item here is essential and very testable. In fact, throughout this topic, financial reporting and analysis, the primary framework or the primary standard that we will consider is IFRS, and then sometimes there will be references to US GAAP, but think of your anchor or the main standard as IFRS. So within the framework, we have reporting elements, and these reporting elements will essentially tell us about the performance and the financial position. So by reporting elements, which we talked about earlier, we are talking about revenue, expenses. In terms of financial position, we need to understand assets, liabilities. So there will be information about performance and financial position. Then within qualitative characteristics, we need to have relevance. So the material presented in the financial statements and reports need to be material, they need to be relevant. This is the information that allows investors to make decisions about what to buy, what stock not to buy, and so on. Information needs to be comparable, information needs to be timely, faithfully, which means correctly and honestly presented, verifiable and understandable. The core objective of the framework is to provide financial information useful in making decisions about providing resources to the entity. The entity in this context is the entity that is creating the financial reports. The major customer of these financial reports would be investors who need to decide whether to lend money to the company, or investors who need to decide whether to buy shares in the company. The underlying constraint often in the context of creating financial statements is a cost-benefit consideration. You would want to put in a lot of money into creating. The constraint in the context of the framework is a cost-benefit consideration. Clearly, it will cost a lot of money to create a perfect financial report, but then after a certain level, the benefit doesn't increase that much. So bottom line is that there needs to be a balance between the cost and benefit. The assumption used is accrual basis, and the other assumption is going concern. Accrual basis we've talked about. Going concern means that we expect that the company will keep operating. These are the required statements: the balance sheet, the income statement, comprehensive income, changes in equity, cash flow statement, notes, and statements from comparative periods. So you'll notice anytime you pick up an annual report, you will have the financial statements for the current period and then also one or two prior periods. This box talks about the structure and content. Classified balance sheet. So this means that you need to organize your balance sheet. The standards will specify the minimum information that needs to be presented on the balance sheet or the income statement, and then obviously details will be in the notes. The framework will specify what information needs to be clarified or given in the notes. Also learn these general features: fair presentation, going concern, accrual basis, materiality and aggregation, no offsetting, frequency of reporting, which talks about how often the reports need to be presented, comparative information, and consistency of presentation. I am going over these items because they can easily show up on your exam, and you need to actually memorize everything on the slide. The next slide talks in general about effective financial reporting. So IFRS is a particular framework, and on this slide we are saying what an effective framework needs to have, because there might be some companies that are following a different framework. For example, companies in the United States will follow US GAAP. So here are the basic characteristics. Number one is transparency, which means that the financial statements truly reflect the underlying economics of the company. They need to be comprehensive, which means that the reports should encompass a full spectrum of transactions that have financial consequences. And number three is consistency. Similar transactions should be presented in a similar manner across companies and time periods. The next point is that it is difficult to satisfy all these three characteristics simultaneously. Trade-offs are required. At times, different frameworks make different trade-offs. This becomes a barrier to a single coherent framework, which is something we'll talk about later. So just to give you an example, in terms of valuation, should you use historical cost or fair value? So if you buy an asset for 100 5 years ago, should you now, which is 5 years later, show the asset at historical cost less depreciation, or should you show it at fair value? Different financial reporting standards might make different decisions. The case for historical value is that it's more objective. The case for fair value is that it is a better indication of current economic reality. But there might be a lot of subjectivity associated with fair value. So we can't say one is better than the other necessarily, but clearly different entities can make different decisions. Standard setting approach, either principles based versus rules based, and it is said that IFRS is principles based, whereas US GAAP is based on rules. And then measurement, asset liability versus revenue expense. So now that you have studied FRA, and hopefully this is a review for you, which means that you've already covered material and this is a refresher. If you think about it, if a company is using the FIFO method, with the FIFO method, the emphasis is on the balance sheet, where we say that the balance sheet is more indicative of the current economic reality. But that compromises the income statement. Most US GAAP companies will use LIFO, where the income statement is more accurate, but the balance sheet is less. So notice that in the decisions that are made, by definition, sometimes you are either paying more attention to the balance sheet or more to the income statement. And different accounting standards might make different judgments about what is better. Standard setting bodies and regulatory authorities. Standard setting bodies are in the private sector and generally self-regulated. Board members are experienced accountants, auditors, analysts, and academics. The two major standard setting bodies that we are concerned with are FASB and IASB. FASB is United States based, and this is the entity that comes up with US GAAP. IASB is an international organization, and they are the ones who come up with the IFRS. Regulatory authorities are government entities. For example, you have SEC in the United States or FSA in the UK. They have the authority to enforce financial reporting requirements. They can overrule private sector standard setting bodies and establish standards in their jurisdiction. These are the entities that regulate capital markets in general. There is an organization called IOSCO. This is not a regulatory authority, but the various regulatory authorities in the world are members of this organization. So you can think of this organization as an umbrella organization that oversees, or that essentially is a support organization for the various regulatory authorities around the world. This organization has established objectives and principles to guide securities and capital market regulation. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.